Good morning. This is your weekly update with Jim Stewart. I'm the Chief Investment Officer here at Worth Asset Management. Today is October 3rd, 2022, and I'm going to go over your three threes for the week. I'm going to go over the top three market movers and economic data for the week, plus performance for the week and for the quarter, our favorite three asset classes, and how we are positioned on the short term for both equities and for bonds. So let's jump on in.
Okay, because last week was the end of the month and also the end of the quarter, we're going to go over the performance for the major asset classes on a weekly basis, a quarter basis, and on a year-to-date basis. Another down week for most of the major asset classes. Gold and Bitcoin were barely up for the week, but everything else, US dollar, the bonds, and equities, were all negative for the week. But for the third quarter, the only major asset class winner was the US dollar, up 7.3, while bonds were down 1.7 and 4.7, while most of the major asset classes were down 2 to 4 to almost 5, where the international index really got hammered, down 10%, and emerging markets were down 13. Gold and commodities were down over 7, and Bitcoin down about 2.4. On a year-to-date basis, we still only have two winners. That was the US dollar and commodities so far. Bonds are down now double digits, down 14 and 15%, while the equities are down over 20%, and some down almost over 30%, with Bitcoin bringing up the rear, down 58%. Okay, but let's go over the top three market movers. We had PCE price index, which moved the market last week. Number two is jobs. We have a lot of payroll data coming out this week for September, so that will probably move the market. And number three, we're going to go over the charts of the week, which are our bond volatility. All right, so last week we had the final revision for our second quarter GDP, and there was no change. It's still negative 0.6 for the quarter. So that's still the second quarter in a row that have been negative. So our textbook version of a recession, and we'll see what third quarter has in store with us in about a month. But the mover last week was the PCE price index for August, and it was up more than expected, down 0.3 when the estimate was up 0.1, which lies being a decline. But the biggest part of the PCE that was a concern last week, again, goes back to the core piece. Just like in the CPI, when we take out energy and food, for the core PC, it went up 0.6. Okay, so we all know that gas and oil prices are coming down, but everything else is going up. That's what's concerning the Fed and why they're remaining hawkish. But there was a positive that came out of the PC. The personal income or wages edged up to 0.3 in August. So, however, while the Fed is fighting this inflationary problem by raising interest rates, they also are in effect raising borrowing costs. Okay, so when we do that, so if you're going out there and now starting to borrow, the average credit card APR right now is sitting at 21.64. Okay, that is a decade high, if not even longer. So don't do it. Bottom line is there's better ways to do this. You're giving up 21% if you're borrowing money right now. So what people are probably going to end up doing is they're going to cut their spending, which is going to slow growth, which is going to slow down this economy. So it's a catch-22 here. Good news, though, for those that have existing credit cards, it's only up 16.65 on the APR. So that's only about a 27-year high. So still, again, not great news, something you don't want to do. You want to get rid of those credit cards if at all possible. All right, but let's go over what we have on the economic data calendar for this week, and a lot of it is taking a look at the labor markets. So Tuesday, we have the JOLTS report, which is the job openings and labor turnover survey for August, and it's estimated to come in at 11.1 million, and that's down from 11.2 in July. Wednesday, we have the National Employment Report for September, and which leads us into Friday's jobs report, which is the non-farm payrolls for September. And right now they're estimated at 250,000 jobs, a little bit lower than last month's 315 in August. But what the most important thing to look at again is the trend. And right now the trend, as you can see, is down. So we've got to hope that these things continue to stay or don't start to go negative like what we saw in COVID or back through the great financial crisis. So as long as we can stay positive and still create jobs, that should be a good thing. All right, let's go over the chart of the week. And it is bond volatility. Yes, bonds have volatility just like equities do. Equities, they call theirs the VIX when we take a look at the volatility index for equities. On the bond side, it's called the MOVE index. Okay, and it is currently sitting at one of the highest readings in over its 30-year history. And so when we get above this, the second time now we've been above 150 this year. The last time was coronavirus, and the time before that was the global financial crisis. So something we've got to keep an eye on because the volatility is extreme on the bond market side. Okay, and the thing to kind of keep in mind is typically the bond volatility and the stock volatility, they trade in concert with one another. When one of them's up, so is the other one. Okay, whether it's coronavirus or the financial crisis, they're typically traded lockstep with one another. Well, we did have one period back in 2013 when Bernanke was the Fed chair. He talked about tapering. And so we saw the bond market react to that. Well, he didn't end up tapering, it came right back down. Well, this time we are actually raising interest rates and tapering, pulling back on bond purchases, and you'll see the volatility go up. Now, the thing to keep in mind is that one or two things are going to happen. Either the equity markets or the equity volatility is going to start to go up from here and catch the MOVE index, or finally we're going to, maybe the Fed is going to pause eventually and start pulling this back down. You'll see some of that volatility come out of the bond market, or a combination of both. But what has that done to the bond market this year? This has been like no other, in a 46-year history. The ag index came about in 1976. So in its 46-year history, this is the worst start of the year for the aggregate bond index. And this has really hurt the seniors, the ones that are relying on interest rates, etc. So their bonds are depleting, and they're feeling the pain of this on the bond market side. And this is the worst year in its 46-year history. Last time, the worst year prior to this was only negative 2.9, and that was in 1994. So, so unless the bond market is going to return about 20% over the next 3 months, this will go down as the worst year in over the last 46 plus years for the bond U.S. aggregate index. Last time we saw this type of returns on the bond side was probably 1931, which was during the Great Depression. All right, so let's go over the top 3 asset classes on a long-term basis for October 3rd. Guess what? No change again. We still have T-bills, U.S. dollars, and utilities. Defense is still on the field and the primary driver of this market. All right, so let's go over the bonds on a short-term basis. And again, we go over these every week, so you can take a look at where we're positioned on a short-term basis. And again, we went to protect mode in January 3rd, and again in August 29th in the bonds. And the bond prices have gone down because yields have gone up. They've gone up from 1.55 at the beginning of the year to 3.8 through Friday. And that's what has dragged down the index price for the aggregate bond index. Now it's down 14% year to date. All right, so let's go over our equities now. And again, we go over these every week. We've been through 3 protect modes. We're currently in a protect mode as of August 30th. And a couple weeks ago, I said if we break this support zone, we will go and retest the June lows and possibly go down to these other levels of support in the 3540 to 3400 range. Well, we went down on Friday down to 3585, came down pretty close. Now, the futures are up this morning, so we may get a bounce. Now, after having one of the worst Septembers in a very long time, down 9%, the worst monthly drop since March of 2020 COVID, we probably will see a bounce this month or possibly into next month, and probably right back up to this now resistance zone. Used to be support zone, so we should probably will see this. Now where we go from here will probably determine how we finish out the year. If we bounce off that and come back down, or if we bounce through that and go up, that will be the biggest determinant of how we finish out the year, so we shall see. All right, that's it for this week. Our next update is Monday, October 10th. As always, thank you for joining us. Continue to like, follow, and subscribe, and we will check you out next week. So have a wonderful week trading.